As we all know, global tax laws were formulated nearly a century ago when digitization did not exist. And it was not possible to carry out a business in another country without having physical presence or without having to be able to visit there. But now, situation has changed, as we all know, and it is possible to do so. A lot of income was escaping the tax net of several countries due to this digitized economy, where it posed a very piquant problem, where there were few countries and companies where they were having base in few countries, while markets were from around the globe. And again, the countries which offered markets were not able to have a consensus on how to deal with this phenomenon of having a base at few locations and centered with only few companies. So while a few countries attempted a unilateral approach, with India in lead introducing the Equalization Treaty, the inclusive framework of 135 countries under OECD adopted a multilateral approach and introduced Pillar 1 and Pillar 2 approaches to tackle challenges in the taxation of the digitized economy, as also to assure and ensure minimum corporation tax rate. On the other hand, the UN has adopted a bilateral approach. The end result, all three approaches have their own challenges, and we as a tax practitioner community are left to grapple with all three approaches. Well, this is just to put things in perspective, as today's session will deal with all these three approaches. Let me now turn to give you a brief introduction of the BCS for those who are not members or who may not have been fully familiar with the activities of the BCS. BCS is one of the oldest voluntary body of accountants with 73 years of rock-solid history. It was established just 6 days after the ICAI and has more than 8,000 members. Its knowledge dissemination averages about 250,000 man-hours every year. Its publications, with contribution by volunteers who are experts in the field, have been much in demand. The journal, published every month by BCS, is one of the most well-respected publications and is widely read across the industry, profession, and bureaucrats. BCS, over the years, through its knowledge dissemination, dedicated efforts of the volunteers, and networking platform, has been responsible in creating several domain experts and leaders. It has presence on all prominent social media and has substantial following there. I urge you all to reap maximum benefits through participation in the several activities that the BCS offers. Visit to the BCS website at www.bcsonline.org, and that would help you to have the full view of those activities. I would now not stand between you and the speakers, and I would request straight away Chirag to introduce today's speaker. Thank you all and good luck. Chirag, over to you.
Thank you, Mir Bhai. Welcome to all the attendees, and I have a pleasant task to perform about introducing our today's speaker. Shri Radhakishan Rawal is a senior advisor to Dua Advisors LLP and has about more than 25 years of professional experience. He's worked earlier with Deloitte as India tax partner and also with PwC for around almost 18 years. Radhakishan has advised several MNCs and domestic companies on a variety of tax and regulatory issues. He is a former subcommittee member of United Tax Committee and actively participates in the work of UN Tax Committee. He has written white paper conceptualizing UN MLI and UN Tax Committee. He is currently working on development of that UN MLI. He has also actively contributed to OECD in public consultations on Pillar 1, started in the year 2002, where he has authored books focusing on international tax issues. He's written several books published by Indian as well as foreign publishers. Some of his books are book on profit attribution to PEs, taxation of cross-border services, and for last 4 years, he has been releasing books containing his analysis of provisions of the Finance Act. With this, I would request all the participants to welcome CA Radhakishan Rawal on BCS platform. And over to you, Radhakishan.
Thank you very much. Yeah, thank you for the nice introduction. I hope my screen is visible to everyone.
Yes.
Okay, thank you. To begin with, I'll say I would like to thank BCA for giving this opportunity. Another important thing is that whatever comments I make here, this are in my personal capacity. This doesn't represent the views of any organization. I've been a former member of UN subcommittee on taxation. Nonetheless, these are my personal views, and the idea is not to share anything confidential or something which is not in the public domain. So, in today's session, I have about 40 slides, and the approach which I adopted for this session is not to make it too technical. We are in a very interesting time, once in a century kind of an event, is happening around. And in today's session, what I intend to do is to give an overview of, what's happening around, to address the issue of digital economy taxation. So the approach is not to go too much into technical, but to, just give an overview of the developments. There's also a feeling that not many Indian professionals are necessarily studying the international developments around this. Thinking that it's still a far off thing to happen. And from that perspective, I'll be keeping this at a high level. So with that, let me start the presentation. Well, Mr. Seth has already, made my task easy by, in a manner, describing the problem. But I would use these diagrams or pictures to explain what the issue is. Many of you may have noted that in the last week of July, I think it was 29th of July, there was an incident which got reported and which said that the Earth finished its rotation little earlier by maybe 1.5 milliseconds. Maybe it got reported, noticed by some people, did not get noticed by some people, but it's a very interesting, event to happen. As a professional, we may want maybe 30 hours, 36 hours in a day to finish everything which we want to do and also focus on the personal life. And of course, Amazon and Netflix, to everything we need probably 36 hours. But the world is going in a different direction. The days are becoming shorter. And this is not the first incident which got reported. These incidents have been happening, and maybe the global warming could go on increasing these events. But the issue is what happens, when this becomes repetitive, and the days really become shorter than 24 hours. It would make several things around us redundant. The very basis of life is for us, and if that is reduced, many things will get disturbed, and several things will be distorted. So essentially, the problem of digital economic taxation is nothing but things getting outdated. Other pictures which you see, a Walkman, a camera roll, a gramophone recorder, a pager, this all things died and become outdated as when the technology improved and the new products came in. Similar thing has happened with the tax laws as well. The current tax treaty law, which we are practicing, was written about 100 years back, where it was a little difficult to contemplate a business being carried out without having a physical presence. Then an agent was included to create an agency P. Then probably the concept of service P came in. But then today, the business models do not require any sort of presence. So when the technology has moved too far, the tax laws did not move, and that's why they have become outdated and obsolete. And that's the reason they are not giving the desired results. Precisely to address this challenge, the countries are taking different approaches. I would say the countries are really struggling. The smartest organization in the world, be it OECD or UN, they are all struggling to address the issue because the problem has remained as it is and solution is not yet achieved. The question is, what about Pillar 2? And when we look at the OECD package, it is packaged as Pillar 1 and Pillar 2. And if we see, even Pillar 2 is shown as a tax challenges arising from the digitization of economy. Now, if I have to answer this question to my mind, and I want to believe that there's nothing common, between Pillar 2 and digital economy. The real issue which they are trying to sort out has nothing to do with digital. Essentially, what Pillar 2 is doing is that they are trying to address the issue of so-called race to bottom, when the countries go on reducing the corporate rate of tax to attract more and more FDI, to attract more and more business activities. And that's the core issue they are trying to address. And that issue, to my mind, is not arising as a result of digitization. That's a standalone issue and could have been addressed on a standalone basis. However, the way these things developed, it was a part of a political compromise or a political arrangement wherein a decision was taken that both Pillar 1 and Pillar 2 should be taken together. As Chairman said, there are 135 countries, there are 137 countries who are part of this inclusive framework. In fact, there are 141 countries out of the 137 has agreed on this solution. And when such a large number of countries come together, it becomes obvious that it would be a compromise solution. So which is being repeatedly said that this is a compromise solution which doesn't resolve all the issues, which each of the country may be facing. Now, having said that, let's try to understand these three words: unilateral, bilateral, and multilateral. Now, these words, I would say they are words of common usage. They're not legally defined for the purpose of a taxation. And going by that perspective, unilateral would mean something which is done on a standalone basis in the context of taxes on digital economy. Unilateral tax is something which is done by a country on its own without necessarily taking into confidence or without necessarily taking into a dialogue or a negotiations with other countries, which is a simple term, unilateral. Bilateral, as the term suggests, is between two parties, and bilateral solution is something wherein there will be two parties to the solution, and these parties would jointly develop the solution. And multilateral is essentially wherein there are several parties involved, and they would jointly develop a solution which is acceptable to all. So in today's session, in the context of digital economy, unilateral is essentially the equalization levy or the DSTs or digital service taxes, as they are said globally. Bilateral is essentially Article 12B of the UN model, which we will look at. And multilateral is something which is being done by inclusive framework and OECD jointly. Well, before we get into these three approaches, let's try to understand what is the Indian approach to digital economy. What is that our Babus, our efficient officers sitting in North Block thinking, and how they have driven this? We can see that we have done a number of things to tax digital economy, and we are the pioneers to start DSTs way back in 2016. Maybe we were among the first countries to introduce equalization levy outside of the tax treaty. And that was a 6% duty which was introduced in 2016 on online advertisement and related services. Then came the 2% equalization levy which got introduced on 1st of April 2020. And this was introduced on online sale of goods and provision of services. I would say, it was much more difficult to deal with this 2% levy considering the manner in which this got introduced, the professionals had, probably 7, 8, or maybe less than 10 days to understand what the new law is, because it didn't get introduced in the finance bill as such. It got introduced at a subsequent stage. Thereafter came the concept of significant economic presence, which is explanation 2A to section 911. And this will tax the income at the rate of 40%. And SEP is created on account of download of data, software, or other transactions, and continuous solicitation of business and interaction with users in India. This concept is as such new. However, this concept is sitting as a part of the domestic law, and that means a benefit of tax treaty is available. Then came explanation 3A, which is essentially, in tax on sale of advertisements, sale of data and products. This is again sitting in the domestic law. Income is to be taxed on a net basis at the rate of 40%. And then there are other measures like 194 of GST and OIDR, which are more of a domestic or indirect tax law measures. So if we see here, India has done several things to levy tax on the digital economy. Some of it is in the domestic law, some of it is attempted outside of the domestic law. While all this was evolving, and something like a concept of SEP, was introduced maybe somewhere in 2018-19, but never got activated. That got activated at a subsequent stage, in a little revised form. But when all this was, getting introduced, one probably got a feeling that while India is participating actively in OECD inclusive framework to design the international law, it is parallelly, creating a law in the, for the domestic law as well, so that when the international agreement happens, this probably could converge. However, when we look at the final law, or maybe, near to the final law, which is coming out from OECD, doesn't kind of, a match with this, and which probably indicate that, well, this things were conceptualized, or these things were developed by different people in an independent manner, and they are not necessarily connected to each other. If I have to draw a diagram indicating what are the Indian measures, I would probably come up with something like this. Essentially, what this indicates is that there is a lot of overlap. We have a section 5, which I would believe that, which is a great section having a huge scope. The concept of accruing and erasing is so wide that a lot of things could be covered in that. However, we kept on introducing section 9, the demi fictions thereafter, which is section 911, then came explanation 2A, 3A, OIDR, and equalization levy. So while we have done a lot of things around there, but there's a lot of overlap, and only one thing which remains outside of the tax treaty, or which is perceived to be remaining outside of the tax treaty, which is equalization levy. Well, with that, let's go to the unilateral measures. What I've tried to do is that I've tried to, give a picture, which gives the timelines of these measures as well. So if you remember, we had the final report of BEP section 1, or rather all the actions in somewhere in October 2015, and India introduced equalization levy immediately thereafter in 2016. So this EQL or the unilateral solutions have prevailed 2016 onwards, and they are still continuing. We just had a brief look at EQL in India. Now let's look at what has happened globally. Based on a tax analysis article, and some of the things which I say in this session are not based on my primary research. They are based on secondary research, in the sense that they are picked up from different articles, which I have read over a period of time. As of June 22, there are around 27 countries who have enacted DSCs or similar measures in the domestic law. There are 15 countries who have announced or proposed a similar tax policies. So this 15 would add up to 27. And then there are the rate of tax is ranging in the range of in 1.5 to 7.5%. So this is the range in which the taxes are levied or proposed to be levied. What is important is that it's not only India as a developing countries who have introduced this, but the developed countries and the most developed countries are also very actively doing this. So be it European Union or Canada, or any other European country, they are all a part of it, and everyone is equally considering or have already introduced unilateral measures. Then the issue is, what is the issue? If unilateral measures are introduced by so many people, what are the difficulties? Why it is not the end of the matter? Well, as I said, there are several issues in each of these approaches, and I narrate some of these issues here. So unilateral measures, I would say, they are complex in nature. And we have seen the complexities in these unilateral measures, when we have seen the equalization at 2%, equalization levy at 2% coming in the domestic law. There was a period of time, wherein it was very difficult to give any sort of advice, on the new provisions, because we had only around 10 days to study this. And again, the manner in which these provisions were drafted were too complex. If we see the approach of authorities, and there used to be interactions with authorities, the approach was probably not to give a final solution or not to clarify what the intention is. Because from the perspective of the tax authorities, they would not want to give up any revenue. They would want to understand the tax concepts or the business concepts, the business models better, before saying that this is covered or this is not covered within the scope of EQL. So they kept it a vague sort of it. Again, this also could be for the reason that this was always seen as a temporary measure, because the belief was that once OECD comes up with a solution, this will be withdrawn. But however, this approach does make a lot of challenges for the practitioners as well as the countries. Sorry. The biggest issue is the credit for taxes paid under DSTs in the country of the e-commerce operator, the entity which is earning the income. And if this is seen as a levy outside of the tax treaties, the home country, the country of residence, does not have an obligation to give treaty benefit. And what it means is that there would be a double taxation. The country which is levying DST would levy tax. The credit will not be given in the home country, and the home country would again levy tax on it. So that's a sort of a double taxation. Question of availability of tax treaty, is, as I said, it's perceived that tax treaty benefit is not available, and we'll look at this in a little more detail. These DSTs are treated as discriminatory in nature. They are seen as levying or violating a lot of the international tax norms. And then as a result, this sort of, starts a trade war, and the countries may go to levying tariffs on this. So let's look at the next issue. We have perceived, we have believed that treaty benefit is not available, but I would want to believe that maybe this is not adequately tested. If we look at a treaty provision, any treaty provision would say, define what are the covered taxes. And Article 2 would give a definition of covered taxes. And I would request you to focus on the words which are there on the left-hand side in bold. So the section, the convention is applicable to any taxes which are identical or substantially similar levied by other contracting state after the signature of the tax treaty, which are in addition to or in place of the taxes referred to in paragraph 1. So what it means is that when the tax treaty is signed, if a country introduces new taxes after signing the tax treaty, and these new taxes are comparable, identical to the existing taxes, then these taxes are to be treated as covered taxes. So the question which we have to answer is equalization levy, does it qualify as a covered tax? And if we analyze in detail, probably we'll end up saying that yes, this is a amount of covered tax. EQL is substantially similar to and is levied in place of income tax. And there's no debate around this. Under EQL, specific exemption is given under section 1050. Levy of tax on a gross basis is not something which is unusual in India. We have lived with gross basis taxation for years now. And if you look at the machinery which is getting implemented, it is essentially several provisions of the Income Tax Act which are applied for implementing EQL. So it probably is not too difficult to come to a conclusion that yes, equalization levy is qualifying as a covered tax. Then where is the problem? And one may say that, well, section 90 subsection 2 is something which could be seen as creating a problem. And that's for the reason that this is a section which effectively says that the treaty provisions would override the provisions of the domestic law. But we are saying that we are already covered by the treaty provisions because EQL is not. Then where is the challenge? And one may want to say that challenge is getting created by virtue of reference to subsection 1, and subsection 1 is worded like this. So section 90 subsection 1 authorizes the government to enter into tax treaty to eliminate double taxation, which is paid under this act and taxes in the other country. So one has to question, if one has to answer, is equalization levy a tax paid under this act, under the Income Tax Act? The answer would be low. It's levied under a Finance Act 2016, and there is no comparable provision in the Finance Act 2016. So this gives an impression, this creates a doubt as to whether benefit of section 90 subsection 2 should be available. However, I would want to believe that there is a strong argument that this is available. The mere fact that equalization levy is not a tax levied under the Income Tax Act does not does not result in a conclusion that a tax treaty is not a treaty which is contemplated in terms of section 90 subsection 1. What it means is that if we are going to come to a conclusion that equalization levy is nothing but a covered tax, then there's a strong case to argue that yes, this is treaty benefit is available. However, nonetheless, as we see now in practice, it appears that it is generally accepted that treaty benefit will not be available. Maybe there are some players who may have made this claim, but then we probably will come to know only after maybe 5, 6, 7 years when matter goes to the tribunal. So having said that, nonetheless, we keep that argument open. I would say this is treaty benefit issue is not adequately examined. Maybe in the future the answer may change, but for the moment, we'll proceed on the basis that treaty benefit is not available, and that's why we look at this presentation. Now, I made a reference to trade tariff and US proceedings comes into picture. Very soon after the 2% levy was introduced, Section 301 investigation was started in US against this equalization levy. And it was not only against Indian levy, it was against other levies as well. So this is a proceeding under the US domestic law, and under which they come to a conclusion that a law passed by a particular country is not valid or is discriminating against the US companies, and that's why US probably gets a right under the domestic law to take actions against these countries. So there are several arguments which were made, and the key findings of the USTR report is that Indian EQL is unreasonably contravenes the international tax principles. It is levying tax without creation for P. It's vague, it's ambiguous, and it's taxing companies' revenue rather than the income. It burdens or restricts US commerce. It is discriminatory to the US companies. It will create a huge compliance cost to implement this. And Indian DST in special, is kind of an outlier compared to the other DSTs of other countries. There was a Government of India response, which is also available in public domain. The Indian government has tried to give a justification for this, has clarified that this is not something which is discriminating against the US companies, but on the contrary, is trying to remove the discrimination against the Indian companies engaged in the same business. Because when the Indian company is doing the same business and it is subjected to tax in India, but when a competitor from operating from US is not taxed to India, that creates a sort of discrimination. Nonetheless, finally, the proceeding is decided against the Indian levy, and they came to a conclusion that that action needs to be taken in terms of a USTR law, and that action would be additional duties to the extent of 25%, on the products which are listed in the annexure to the report. Now, having said that, they also decided that considering the development at international level about the progress on Pillar 1, they thought of suspending the, keeping the actual levy of tariffs in suspension. It was kept in suspension for a period of 180 days. Obviously, that 180 days period has kind of gone long back, but we haven't seen anything further happening on that. In the meantime, on 21st October 2021, and this is after the October 2021 statement came from the inclusive framework, US signed an agreement or a sort of a compromise. US compromised on a similar position because US had taken a similar approach of levying tariffs on other countries as well, including the European countries like Austria, France, Italy, Spain, UK. And as a compromise arrangement in October 2021, they said, okay, fine, let's keep the entire thing on hold. And under this compromise arrangement, what it means is that the countries which levied DSTs will continue to levy those. They don't have to immediately withdraw the DSTs. They will continue to do it. However, as and when the new law comes in, when Pillar 1 comes in, they would have to withdraw it. And if it so happens that the DSTs collected are higher than the amount of Pillar 1 taxes on amount A, then they would give a compensation for that. So there's some sort of a compensation, so compromise arrangement entered into by US with the 6 countries, under which the DSTs still continue to exist in the world. There's a proposal which is as per the MOF press release, November 2022, that India would sign a similar agreement with US. A similar arrangement would be finalized with US as a compromise arrangement. That was to happen by February 2022. However, we have not seen anything happening thereafter. So that was all on USTR. And when we look at the terms unilateral, and when we start, when we think too much about these terms, more questions would come to our mind. Is that, can there be bilateral unilateral? What it means is that if we look at the Indian approach, and in 2008, for the first time, we saw the Indian comments on the OECD commentary, which is generally given at the end of the document. India said that, we will treat a website to be a P in certain situation. This, to my mind, is, a sort of a unilateralism, within a bilateral tax treaty, because while globally this was not an understanding, India said that we will take this kind of an approach. Nonetheless, we have not seen maybe almost any case, wherein this kind of view was taken. There are some couple of cases here and there, but by and large, they have not used this as a weapon to levy taxes. And then comes the concept of multilateral unilateral. In a situation where maybe more than 35 countries are levying taxes, are levying DSTs, and of course they are looking at each other laws. Is this unilateral at all? Is it not sort of a multilateral, because everyone is doing it? Well, now having said that, let's go to audience poll. This is the question number 1, and the issue is, Jared, you're able to see this, right? You'll be able to launch it, or should I go out to the presentation? Okay, well, perfect. The poll question comes on the screen, and the question is the unilateral approach of charging equalization levy fair on the part of India? And the participants are supposed to accept one of this answer. Yes, so many countries are doing it. There's nothing wrong in doing it. Second answer, yes, a country cannot forego revenue for a period of long time till the time OECD comes up with a solution. And the third is no, we should be a good international citizen, good citizen country, and we should not be creating a chaos by getting into this path. So maybe we'll wait for a few seconds and for the answers to come. Javed, when you see there are answers ready, maybe if you can bring up the answers on the screen, just to see how the audience have responded. Well, we have 72% saying that we should go ahead with equalization levy. A small percentage says for a different reason, and we have 28%, who is saying that we should not do some things unilaterally. Interesting, I would have expected, a much higher number of people voting in favor of a unilateral approach. Nonetheless, this is the the kind of poll we have got from the audience. Let's go to a second solution, which is a bilateral. Only years on the screen because Article 12B came in a record time. It was, the work on Article 12B started after OECD blueprints were available and they were made a part of UN model 2021. So it has come in a record time. Of course, it is, I mean, the value of this Article 12B and the UN approach is different. The UN as an organization operates differently. Nonetheless, it is, it is giving a solution which is, seriously considered by a lot of the parties. And I would say, the reason for which UN was able to do it so fast is that it quickly capitalized on part of the work which was done by OECD. It was available, in some form to UN Tax Committee. They reduce the complexities and try to make it simple and introduce, in the UN model. So let me take you through this Article 12B, how it looks. Essentially, this article is something which is broadly comparable, with the article on maybe interest, dividend, royalties, FTS. We are very much familiar with the structure of this article. This Article 12B is giving a source country the right to levy tax on income from automated digital services. Now, this concept was borrowed from the OECD Pillar 1 blueprint as it prevailed in October 2020. Give a generic definition of ADS, automated digital services, and they also gave a list of 9 items which are to be specifically seen as automated digital services. To remove overlap, the income which qualifies as royalty FTS is excluded from the scope of Article 12B. The interesting part of this Article 12B is that it gives an option to the taxpayer either to pay tax on a gross basis or to pay tax on a net basis. Now, Article 12B per se does not give a rate of tax at which income is to be taxed. The rate of tax is a subject matter of negotiation between two parties to the tax cities. However, the commentary gives a guidance that the rate could be in the range of 3% to 4%. So, whether it wants to offer its income in the nature of ADS to tax at the rate of 3% or 4%, whichever the rate adopted in the tax city on gross basis, or it wants to go not basis, net basis taxation. In a net basis taxation, again, there's a lot of simplification which is introduced because it's understood that preparing a proper P&L account and then looking at amount of allowable expenses is going to be tricky. So there's another way of coming up with a net basis taxation, and a simple approach is that 30% of the qualified profit is to be taxed at the domestic rate of tax. And the qualified profit is determined based on the profitability ratio of the entity. So if the entity is operating at a profitability ratio of, let's say, 12%, then that ratio is 12% is applied on the revenues from ADS derived from the source country, and that is treated as a qualified profit. And that's a profit on which tax will be payable on net basis. Now, this is, I'm not dealing with all the features of Article 12B. I'm only explaining the key features. Of course, when we compare it with, with the OECD form in a current solution, it has gone in a different direction altogether. In October 2020, when they looked at it, they considered automated digital services and consumer-facing businesses. So that was the scope of Pillar 1, which was considered by OECD at that point of time. However, thereafter, they thought it appropriate to include all the businesses, except 2 of them within the scope of Pillar 1. So if you look at the scope-wise, there's a huge difference. And today, Article 12B and Pillar 1 are not comparable as such. So the comparison becomes difficult. Having said that, let's understand, some parts of, UN dynamics and why is that, UN is still an issue. The major problem, is with UN is that it does not necessarily go on the basis of consensus. What is OECD trying to do is that it's trying to develop a consensus solution. I mean, to what extent it's inclusive, that's, it's always a matter of question mark. However, UN has a different approach. It operates on a majority basis, which is one. The second major issue with UN is that it is not the UN tax committee is not an intergovernment tax committee. So while there are 25 members in a tax committee, who kind of work on it, but this 25 members, although appointed by the respective governments, they operate in their personal capacities. So they do not necessarily bind the respective governments. So UN as an organization has probably more than 190, 195 member countries. Almost all the countries in the world are part of this UN organization. When it comes to tax committee, which is part of ECOSOC, Economic and Social Council, that is not an intergovernment committee, and that's what it creates a problem. Again, when we, in fact, I've been attending this UN meetings so almost for 7-8 years now. Professor Roy Radhakishan suggested that I should go and attend when they were working on Article 12A linked with FTS. So I've been attending this meeting, for almost 7 years, and it's very interesting to see the dynamics and the politics, which goes, before a particular article, comes up and is placed before the world. But nonetheless, it's always a tug of war between the developed countries and the developing countries, and generally, it's kind of biased in favor of the developed countries, which means the source countries have to really struggle. Now let's look at what are the major difficulties in this UN solution. The major problem is that, as I said, it's not a consensus solution. And another bigger problem is that there is no mechanism as of date to quickly implement Article 12B. So let's say, entire world accepts that yes, Article 12B is the way to go. This is the correct solution. But the question is, this is to be inserted in a bilateral tax treaty. How do we insert that in a bilateral tax treaty? We have a BEPS MLI, which has made a lot of changes to introduce provisions in the tax treaties, but there is no comparable MLI for the UN model. Now, I've attended several of these meetings, and in last few years, UN has really come up with a very good new articles, Article 12A, 12B, article dealing with royalties. And my suggestion was always that, there is a requirement of a UN MLI if one has to necessarily introduce, one has to necessarily see a practical usage of this article. I'm happy to say that, currently the UN Tax Committee is looking at the proposal. The white paper is there on the website and it can be seen. And the UN Tax Committee is working at a proposal and they have started looking at how to create this MLI. Nonetheless, that does not necessarily, address the challenges around Article 12B, The major challenge would be that, even if it is accepted that MLI is there in place, this becomes success only if the countries are willing to sign that bilateral tax treaty. Sorry. If the developed countries like US, UK, who are the headquarter countries for this digital companies, if they do not sign, then probably Article 12B is still going to be a theoretical provision. So that's the problem with the bilateral solution. Now let's go to a multilateral solution. And multilateral solution is something which is sorry, which is worked upon by OECD, an inclusive framework. And that work is started in 2013 as a part of BEPS project. Digital economy was BEPS Action 1, did not see any solution in 2015. And the project is still going on in 2022 as well. So this is a solution which is currently being worked upon by OECD inclusive framework. It is essentially giving a new taxing right to market jurisdictions on amount A without creation of a P by the foreign company. As I said earlier, it includes all the businesses except extractives and regulated financial services. Except this, all the businesses are included. However, the threshold is kept at a really high level. For a group to be covered by Pillar 1, the group revenue should be minimum 20 billion. And on the top of it, it must have 10% profitability. Only if these conditions are satisfied, provision of Pillar 1 is applicable. And then there are some studies which are done around this. And the studies say that maybe in the entire world, less than 80 groups would qualify for this. Some has come up with a number of 83 groups. Some are saying it's 76 groups, because not all of the data which is there in public domain. But one can safely say that the number of many groups to which Pillar 1 would be applicable would be less than 85. Now let me explain how these things work. So this is an approach wherein to levy tax on a group basis. So what it does is that it takes a profit of the entire group, and that is divided in two parts: routine profits and residual profit. Now the transfer pricing colleagues would interpret the residual profits in a particular manner. However, what they've adopted here are completely different concepts. They are very simple concepts. They are not necessarily the transfer pricing concepts. So what they say is that 10% of the revenue is to be seen as a routine profit. That's a state formula. And the profit which is beyond that is to be seen as a residual profit. And 25% of this residual profit is to be treated as amount A, and this amount A gets distributed to market jurisdictions in the ratio of the revenues which is derived from these countries. Now, to achieve this, they have introduced new rules. These new rules are dealing with revenue sourcing rules, nexus rule, there's a tax certainty process, and as I said, there's a group approach. I'll explain some of this in the subsequent slides. And in the bargain, when this concept is introduced, all the countries are supposed to withdraw the unilateral measures. A very simple example, to very quickly explain how it works. In this example, the group revenue is 25,500, minus 26%, which is more than the threshold. Now, this group has a physical presence only in one country, market 1, market 2 and 3. There's only remote activity. So going by the formula, one would first arrive at the amount of routine profit, which is by reducing 10% of revenue from the profit before tax of 25,000. So we come to an amount of 4,000. The 4,000 is essentially a residual profit, and 25% of this residual profit is to be distributed amongst the market jurisdictions in the ratio of the revenues derived, which will be 2,000, 18,000, and 5,000. So, there's a lot of simplification. The entire thing is done by way of a formula to divide the profits. Now, let's try to understand what is the nexus rule. A country is allowed to levy tax on amount A only if there's a nexus. And nexus rule means that when it is a country with a GDP of more than 40 billion, there should be a minimum local revenue of 1 million euro derived from that country. Where a country with a GDP is less than 40 billion, the threshold is 250,000 euro. So what happens when this threshold is not met? When this threshold is not met, that means there is no nexus and the country does not have right to levy tax on amount A. Now, well, this is, a very simple solution, but also kind of, a big question mark, when it comes to the tax policies or tax rules settled so far. When we look at the tax treaty, a source country get a taxing right even on a single dollar of revenue. Whereas for amount A purposes, a country is denied taxing right if the minimum revenue is not derived from that country. I would say, something which is clearly against the developing countries, as against helping out the smaller countries, it's effectively taking away the rights from them and giving it to the larger countries. So I would say this is something which is, not a good policy, so to say. Next comes the revenue sourcing rules. Now, these rules essentially determine the country from which the revenue is derived. So if we look at the revenue sourcing rule under the existing tax treaty, okay, we will say the revenue is sourced in the form of interest. Let's say if we talk about interest as revenue, it is sourced from the country where the payer is situated, or if a non-resident has a P in that country and that P is bearing the cost of interest, then the revenue is sourced from the country in which the interest is, where the P is situated. So this is how, this is the current revenue sourcing rules are there in a tax treaty. For Pillar 1, the revenue sourcing rules work in a different manner. So what they've done is that they have tried to divide, they've tried to conceptualize all sorts of businesses, all sorts of revenues, and given a revenue sourcing rule for each type of business. So let's say if we talk about advertisement services, the revenue is derived for online advertisement services. It's treated as arising in a jurisdiction where the location of the viewer is situated in that jurisdiction. So this has nothing to do with the company which is making a payment for the advertisement. Let's say a payer company is situated in country A, but the advertisement is seen by viewers in country B and C. The revenue is arising, treated as arising from country B and C because the viewer is situated there. So in a similar manner, they have come up with rules, and these are the very detailed rules. So of course, these are going to cause a lot of challenges for the countries to determine the country from which the revenue is arising. But effectively, what it does is that these are the revenue sourcing rules, which determine, which country has a new taxing right. So this is essentially sort of shifting the country taxing right from one country to another, or giving a new taxing right to another country. So these are, a very interesting and very important set of rules. Another very interesting issue which comes up when we look at this is the issue of double counting. Now, very interestingly, when this new mechanism comes in, it will not take away the old mechanism. So the current tax treaty rules and Pillar 1 would be applied at the same time in parallel. And that's where, it's understood, it's perceived that there could be a double counting. So let me explain with this example, what is double counting. The picture on the left-hand side, what you see is that there's a M&E group which has a presence in 8 countries. It has a branch in 2 countries, C4 and C6, a subsidiary in C8, and ultimate parent entity is in C3. When Pillar 1 is applied, amount A is allocated to country 1, country 3, country 4, country 8, and country 6, and country 7. Now, what happens is that country 4, 8, 6, and 3 already have taxing rights because there's a physical presence in that country. And that's why there's a taxing right. And the same country gets additional taxing right in the form of amount A. And then the question comes up is that, does the country have the ability to levy tax on the same amount twice? And that's the concept of double counting. Now, a very interesting question. I would say nobody has, a very clear answer to it, because we are kind of working on a simplified conventions. These are not exact scientific methods, but they are just working on a formula, and what goes behind that, it's not possible to determine. However, when we look at conceptually, what is there in amount A is only a part of the 25% of the routine profit, residual profit. And then one could always argue that, well, what was taxable under the domestic law, read with the tax treaty, was not part of this 25%, was coming from the balance 75%. And that's why there's no double counting which has happened. However, as I said, this is a question, to which there's no clear answer. And that's where they have come up with a solution to address this, which is called marketing and distribution safe harbor. So essentially, what they're trying to do is that first they give some allocation as amount A to the developing countries, and then they try to reduce the quantum of amount A by saying that, wait, no, but you already have levied tax on some part of it. So this is, I would say, one of the biggest controversial issue, in the negotiations which are ongoing. Well, there are several countries which say that, well, there's no double counting which is happening, so there's no need for such adjustment. But other group will say that no, there is clearly a double counting happening. So they have come up with this formula to address this solution, and they have come up with a very interesting concept of return on depreciation and payroll, RODP. Very interestingly, while they have introduced this concept, there is nothing which suggests that as a result of higher or lower RODP, one would earn, higher amount of residual profit. Okay, they have simply introduced this. There's no analysis which is made available. There's no practical evidences, to say that when the return on RODP is higher, that means that that represents higher amount of residual profit. So essentially, what it does is that it's dividing the tax base by the amount of depreciation that is treated as RODP in percentage term. So what they're trying to do is that while doing this marketing and safe harbor adjustment, they would try to reduce a part of a residual profit which is supposed to have been embedded in the domestic profits, or which is supposed to have been already taxed by the source country under the existing taxing rights. However, this is, this is a big question mark. There are big inconsistencies in the approach, which they have adopted. I would not get into too much of technicalities because this is still at a discussion stage. The next issue which comes up is elimination of double taxation. So what is Amount A? Amount A is essentially a new taxing right given to the market jurisdictions. And when a new taxing right is given, there should be someone who has to give up the taxing right. Only when that new taxing right goes to some. So under a tax treaty, when a source country is able to levy tax on income, the residence country will have to sacrifice that amount of tax, because they will give a tax credit. And that's the entire question, that in this entire formula-based ad hoc approach, who should be giving up the taxing right? Which country should be given up the taxing right? And obviously, the countries will not be happy to give the taxing rates because their revenues are getting reduced. So what they have done is that they have come up with a 4-tiered approach, which is again based on RODP. And to my mind, RODP, approach concept should not have been used at all. But the way it works is that it works like a waterfall arrangement. The way we see in some of the agreements is that where a country, where an entity has highest amount of RODP, let's say more than 1,500 percentages, that entity is supposed to eliminate double taxation first. And then thereafter, entity which is more than second highest in the queue, that entity will subsequently eliminate double taxation. And this process will go on, these iterations will go on till the time everyone reaches the percentage of 1,500. In the next iteration, attempt would be there to bring everyone up to 150 percentage of RODP, and it goes on. Now, there are a number of issues, with this. One is that it's a too complex and long method. And a fundamental issue here is that it's ignoring the basic principle of elimination of double taxation. Now, when we look at the elimination of double taxation principles, which have settled over a number of years, is that it is the country of residence, which is going to eliminate double taxation. Whereas the method which they have adopted here does not recognize at all the country in which the income is recorded and which is going to levy tax. So in this simple example, we look at state A, that's the country where the revenue on is recorded. So that's a country of residence. Country B, country C is a market jurisdiction. So under Pillar 1, this country will get a taxing right. So this country will have a right to levy tax. However, based on profitability, the obligation to relieve double taxation would be on state B, country B. So, it kind of gives a completely distorted number, when applied in some sort of situations. Well, I mean, having said that, this is something which is in the latest discussion draft, which they've made available to public for comments. And of course, it's open for comments. By 19th of August, people are supposed to give the comments, and then they will evaluate the comments and they'll come up with a final solution for that. So, this is in a way, it's still a WIP. The next is the concept of tax certainty. We've seen that the entire mechanism works at a group level. The profit is determined at a group level, and at a group level, the profit is distributed. So no single individual country, would be in a position to do tax assessment on its own. So there's a group mechanism for assessment as well. So the way it's going to work is that the entire group amount A would be assessed at a group level. The ultimate parent entity, which will be the senior-most entity in the group, would prepare a consolidated return for amount A for all the entities and would file it with the lead tax administration. Now, the assessment, will also happen at a group level. The lead tax administration would have a primary look, and then it may go to a review panel, which would consist of selected tax officers. from selected countries. I mean, not all the countries would be in a position to participate in this review panel. Nonetheless, in the first round, every country will have the ability to object to the assessment. Now, if that kind of objections happen, or if the review panel is not in a position to give take a view, the matter goes to a determination panel, which is like a second tier, or maybe like an appellate panel kind of a thing. And that group, that panel would determine the issue, which would be binding on the countries. Interestingly, determination panel may include private citizens or individual experts. I mean, as I said, this is still getting negotiated and they're yet to come up with a final solution. It also provides, a sort of an advanced ruling for the MNEs to approach them in advance and get a solution. Very interestingly, they are not only talking about, group assessment of the issues around amount A, or calculation of amount A, or the determination of paying entity, or MDSH calculation, or elimination of double taxation. They are going much beyond that. There is a proposal that issues which are related to amount A, and this is a very wide in scope, the transfer pricing issues, the PE attribution issues, or the determination of PE itself, those issues can also be taken in this Pillar 1 certainty process. Now that happens in a situation where the proposal, where the MNE has gone for a MAP proceedings, and the MAP proceedings are not solved. MAP panel does not come up with a solution within a period of 2 years. If that happens, then it goes to a determination panel. As I said, this is still a kind of a work in progress, and a final law is yet to be announced on this. The next is the standstill and rollback provision. As I said, a part of the package essentially requires that all the countries would withdraw all their unilateral measures. So these measures are required to be withdrawn with respect to all the companies. Well, as I said, there are only around 85, less than 85 companies in the entire world which will be paying amount A tax. But in the bargain, one is supposed to give up the taxing rights on all the companies, which is something which is making it, a little disequilibrium kind of a thing. And not only one is to withdraw, but one is also supposed to ensure that in the future, no such unilateral taxes are imposed. And they have given some guidance as to what could be the unilateral taxes, unilateral measures. And the predominant feature of this unilateral measure, to my mind, is that it should be outside the treaty obligation. So if one has to question, would SAP provisions, continue, or would there be a compulsion to withdraw SAP provisions as a result of this? The answer would be no, because SAP in the domestic law in Section 9 is still within the scope of the tax treaty. Well, the latest thing to happen on Pillar 1 is the progress report, which got released in July 11, last month. This is a consolidated version of all the discussion drafts which are released by OECD over a period of time. So what OECD kept on doing is that at a regular interval, they release discussion draft on a particular topic, be it nexus, be it, certainty process, be it revenue sourcing rules, and they invited people's comment on each of this. And now what they've done is that they've introduced a consolidated version. What is new in the recent draft is MDSH, marketing distribution safe harbor, and elimination of double taxation process. There is a yet lot more amount of work to be done on this. The rule of administration of new will be released in October 2000, before October 2022 meeting. Tax certainty, as I said, will come out before October 2020 meeting. The most important multilateral convention, which is yet to be prepared, but the work seems to have progressed on this, and they are contemplating signing ceremony to happen in the first half of 2023. And amount B work is progressing. So as I look at, there are still good amount of issues which are yet to be addressed, because on each of these issue there are still political, differences. There are technical challenges as well as political differences. A very interesting statement which comes up in the cover note to the progress report, and which says that Pillar 1 would become operational once a critical mass of countries, would kind of sign off on this and would make necessary, provision for this. And they're defining critical mass to mean, the ultimate parent entities of substantial majority of in-scope companies and the countries which would be required to give, elimination of double taxation. It's important to understand this because when we look at BEPS MLI, again, there was a signing off, ceremony which happened, but it is still not signed off, by all, maybe the 95 countries who are part of, inclusive framework at that point of time, and not everyone has into, kind of make these provisions. It's not going to come into force for all the countries. To address that, what they are saying is that once it enters into force for critical mass, thereafter this will become operational. Well, so now let's look at what are the challenges around this multilateral solution. The biggest challenge is that this is a too complex solution to adopt. While there are 137 countries participating, not everyone is too happy with the amount of with the amount of complications. The developing countries are clearly saying that we are finding it too complex to implement. There's again a big question mark on whether the taxing rights are allocated in a fair manner. The biggest question, very interestingly, is that still there's no data which is made available. And for a country to determine, whether to go for this kind of Pillar 1 things or not, what is important is data. Some articles suggest that while OECD did impact analysis in 2020, it did not share the data with all the countries which they wanted. So, that's a big question mark, is that why is the data not getting shared? Why is it the countries are denied from understanding what is the precise impact of this Pillar 1? Very interestingly, when we look at these articles, even in the US Congress, the same questions are getting asked, that what is going to be the impact of this Pillar 1 and Pillar 2 on the US economy. And the Secretary Yellen is struggling to give answers to these questions. The next question, as I said, maybe there is a trust issue as well. The developing countries are constantly under a feeling that their interest is not taken care of, and as it happens with any of the OECD solution, first they try to give something, but they equally try to restrict a lot of it. So while amount A is given, okay, a very minimum amount which is going to the developing countries. And the Pillar 1 solution itself, contains these mechanisms like MDSH, nexus rule, which ensures that what developing country gets is, is not something which they should get. So, these are some of the things which are kind of raising a big question mark. Yesterday, a G24, which is a group of 24 countries, made their representations, against this Pillar 1 solution, which would be in the public domain in times to come. Out of this 24, there are 19 countries which are part of inclusive framework, which indicates that there are, internal challenges within the group itself. So there are challenges on technical design, and as well there are challenges on political front. The biggest question mark is whether the US is going to adopt this. And the question is, is also linked with the US internal politics. To pass this kind of a law in US Senate, 2/3 of the majority in the Senate would be required, which probably doesn't seem to be happening. So the entire, pillar 1 application and similarly pillar 2 application is a question mark. If US does not participate, then who will participate? Who's going to give the taxing right? Because if US does not participate, from where the taxing rates will come, because the maximum number of entities which are getting taxed are headquartered in the US. So that's the biggest challenge. A very interesting articles which are available, that in the absence of official data, countries are finding it difficult. Nonetheless, there are some private analysis which are available. One of them is from South Center. They have done some, they mandated some analysis to be done to gather the data. And another is done by another research group. Now, this data is suggesting that, this data is, this research report is essentially trying to compare what the countries may get under Pillar 1 and what it may get under Article 12B. And what they're finding is that it's difficult to conclude, for the reason that in some cases the data is not available. And when we look at Article 12B, there are two options. It could go on a gross basis or it could go on a net basis. And that's where, that's something which makes the comparison difficult. Nonetheless, it does give, some data. It says that the number of MNEs which are eligible for Pillar 1 today is around 76 in one of the research reports. And after 7 years, when this comes down to 10 billion, the threshold will come down to 10 billion after 7 years. It would be around 157 MNEs, 150, 155 MNEs, which would qualify for Pillar 1 after 7 years. So one may say that even after 7 years, the number of MNEs which will be paying tax under Pillar 1 would not be significantly high. A very interesting question which keeps on coming is to how many Indian companies would qualify for that. The research reports which are floating around in the form of articles are suggesting that in the first round, when the 20 billion threshold prevails, probably there's none of the Indian companies which would qualify. But when the threshold comes to 10 billion, maybe there will be some Indian companies, Indian headquarter companies, which will qualify for Pillar 1. Again, it does try to give some data as to what could be the estimated revenue, which the developing countries could get. And the apprehension is that when the impact analysis was done in 2019 or 20, the amount of 125 billion was floating around. But after looking at all the rules in detail, the way they are progressing, it appears that the developing countries, may not get what they were contemplating initially when they decided to participate in this discussion. Again, a very interesting claim which comes is that not everything which is coming out in the form of a rule was agreed. And for what was agreed was an October 2021 statement. And then there are subsequent changes to the design of Pillar 1, which are not necessarily, something which was contemplated in 2021. So, again, there's a question mark, about, whether is it happening, resulting in a fair allocation. So then the question still remains open. Are the DSTs here to stay? And the question comes partly because of what I explained in the previous slide. Again, there's a huge amount of, huge number of non-qualifying MNEs on which one may want to continue levying DSTs. Again, a very interesting analysis which is coming out. If 137 countries, signed a document in October 2021 saying that we commit and we will withdraw this, but that does not seem to be the understanding of everyone. Last month, New Zealand released a public consultation document, and the understanding in that document suggests that the New Zealand may still want to continue with DSTs even after Pillar 1 becomes operational. When we look at the approach of EU members, there are articles which suggest that even the EU members are still continuing to support DSTs. Given a chance, they would want to prefer DSTs. Kenya has clearly indicated that it would not withdraw DST even after Pillar 1 comes into existence. Nigeria is an African country sent to create a group of African countries, which would speak in favor of DSTs. And then, as I said, there are only 137 countries which are then inclusive framework. What happens when another country, which is not as a part of inclusive framework, introduces a DST? Let's say our neighbor, Nepal, something which got unreported or unrecorded notice is that they introduced DST in last month, July 22. Tanzania, which is also again not a part of inclusive framework, is going to do the same very soon. So these are the questions, one may say that, well, these are smaller countries, and if they continue levying it, probably it should not matter. More than 95% of the economy is represented by inclusive framework. Nonetheless, these questions will remain open. That brings us to the second audience poll. Javed, if you can, bring up the solution here. And the question here is, we can clearly see the years, going by 2013, and we're kind of in 2022. The question is, given the technical difficulties and political uncertainties, when do you believe Pillar 1 provisions will be operational? Option A, it will never see a light of the day. Option B, 2024 or 2025. Option C, after 2025. Javed, if you are able to, bring up the things here. Yeah. Yeah. Javed, you able to get the results? Well, interestingly, only 44% of the population participants believe that it will never see light of the day. But still, there's a good amount of people who believe, more than 50% believe that yes, it will come at some point of time. The initial target was to bring it in 2023, but now they revised the target to 24. Maybe if not 24, by 25 it should come. Well, some of this I have already said. I think we are coming to the end of the session. There's one question which is there in the chat box, so I'll try to address it. And there's a very interesting question which is raised here. It's a lengthy question. It talks about FEMA, PMLA, black money, etc., which I'm sure I'm not an expert on all these laws, so I'll not be commenting on this. But nonetheless, I'll address the other part of the question, which is dealing with what happens when GAR provisions are applied on these provisions, on this unilateral, bilateral, and multilateral issues. Well, let's take each of them separately. The unilateral measure comes in the Finance Act 2016, and then the question is, what is the interaction between Finance Act 2016 and the GAR provisions? There are a list of sections which are adopted from the Income Tax Act to Finance Act 2016. And if we see that these GAR provisions are getting adopted there, or do get adopted in the future, GAR provisions could be applied. But to the extent, we do not file this GAR provisions, getting adopted in finance in 2016, GAR provisions logically should not apply. However, we should not forget that when the McDonald's judgment came, the judicial GAR, as we say in India, no GAR provision existed at that point of time. Nonetheless, I would say, frankly, I do not see, GAR provisions getting activated in the near future, because I would say everyone is kind of testing the waters. The approach of the authorities also appears to be that, well, this is still a kind of a transitionary stage, and as yet we're not still any major dispute, coming up. The next could be, what happens between bilateral and GAR provisions. So let's presume that Article 12B really sees light of the day, and there are practical situations in which countries do sign tax treaties with Article 12B. Then the answer is simple. We have a clear understanding that the GAR provisions would be invoked for the purpose of tax treaty as well. So it's possible that treaty benefit could be denied under GAR provisions. Having said that, now we have inbuilt GAR provisions in the form of PPT in the tax treaties itself. So I would say, generally PPT will take care of those kind of situations. Then comes the multilateral issues. The question is, what happens? How will the multilateral solution and the GAR provisions interact? Well, I would say it's little, early to comment on this, because the entire law on multilateral is not yet out. The law which is there, in the progress report, is something which should be a part of the domestic law. So, either this may get incorporated in the Income Tax Act itself as a separate chapter, or it may come as a separate law. Depending on the manner in which this law is introduced in the Indian domestic law, there is a possibility that the GAR provisions could be invoked for this. Well, I think that was the only question which is raised. If there are any other questions, I'll be happy to answer. Otherwise, I'll give it back. Well, there is one more question which has come up. Well, again, a very good question. Do we see that Article 12B is a very ambitious, question, keeping in mind that, MLI, even Pillar 1 MLI, MLI 1.0 is even that has not been completely implemented. Well, I would say, the bigger issue here is that the discussion which is happening in OECD framework, inclusive framework, is done by the countries. So there are 137 countries who are participating, and the participants are country representatives. And what has happened in UN is a work done by 25 members in their individual capacities. So till the time, OECD work completely fails, officially countries may not want to look at Article 12B, because, that would create a situation wherein, as a country, one is parallelly trying to look at, both the solutions. Personally, I see nothing wrong in that. One should always look at plan A and plan B. But having worked so much on Pillar 1, having worked so much as a part of inclusive framework, till that completely fails, probably, 12B, may not be touched. If there's a feeling that, well, Pillar 1 is really unfair to many countries, and, everyone backs out, I see a good chance of 12B coming into picture. And when that happens, there would also be a political will to quickly sign off, MLI 2 for UN purposes and quickly getting it implemented. So it all, would depend on the political will of the countries participating.
I believe there is no other question. And Radhakishan, on behalf of BCS, I must tell you, and also on behalf of all the participants, that this is such a complex subject, and to present this with such lucidity requires some skill. And I believe that this skill was fully at display when you elaborated right from the beginning, the options that are there and the issues and complexities which are involved in implementing it to its conclusion. There are, I believe, more questions than answers. I believe it is, as you rightly said, it's a political will, and also the stand that America takes maybe will govern, or maybe the lobbying of a lot of these companies might bring a conclusion which could be very different than we all have thought and all these countries have worked. But yes, these are just the questions. And there is another interesting angle, which, I just happened to talk with some of these top income tax commissioners, and this is something which they genuinely feel is an issue with them. They said that even for a regular income tax, they are having a lot of operational issues and administrative issues. And when a problem like this, such a complex issue like this comes to be handled by them, whether there would be enough training. Yes, there is consolation that it's applicable to only a few companies, but yeah, 5 years hence, we do not know. Maybe India would have more numbers, but whether it would involve a more legislation, more disputes and litigation, something needs to be really seen. Well, I would hand over the proceedings to Anand for vote of thanks, formal vote of thanks, and great enlightening talk is what I would say, Radhakishan, on behalf of all the people. Thank you. Over to you, Anand.
Thank you. Thank you, Mirbhai. Thank you very much, Mr. Rawal, for distilling and attempting to simplify an extremely complex yet an utmost relevant topic for us. The ramifications of this proposal for us as professionals, our clients, and most importantly, our country can be severely far-reaching. Your worldview and insights into the upcoming future has given us enough food for thought. As Albert Einstein once quoted, the hardest thing in the world is to understand income taxes. I'm sure he had no experience with international tax when he made this statement. So complexities are here to stay, and we at BCS are here to attempt towards simplifying these emerging complexities. Towards this cause, we have a power-packed August and September month, which will cover a whole host of events towards various segments of professional development. We have the indirect tax study circle on 18th of August, which talks about GTA, or Goods Transport Agency, a holistic approach. On 19th August, we have a seminar on intricate issues on tax audit reporting. Again, there are various complexities in that. The 5th long duration course on GST, which is one of the most sought after events at BCS, starts from 20th of August till 6th of October. Seats are filling fast. There's a full day seminar on charitable trust. There have been some recent amendments and circulars in charitable trust, and 2nd of September is where we discuss that. A 360-degree workshop on audit of MSMEs is lined up across 4 days of 3rd, 7th, 8th, and 10th December. And we go into workshop on process automation under GST on 10th of September. This is not it. We have Internal Audit 101 for internal audit professionals on 14th, 15th, and 16th September, and the Company Law Conclave on 13th and 14th October 2022. As professionals, we owe it back to the society, and BCAS has organized a blood donation drive with Brahma Kumari's Hospital in Andheri on 20th of August. Thank you, Mr. Rawal, once again for sparing your time and sharing your insights with us. And thank you everyone for being with us today on this engaging topic. Thank you and have a good day.
Thank you.
Thank you and a good day.